Good morning and welcome to the latest in the IMAP webinar series. Today it's a pleasure for us to have John Guadagnuolo, Hamieh and Angus Mason of the Cashel family office, talking each in their own way about how they think the investment environment and advice environment is being reshaped by COVID. I'm sure most of you who are tuning into this webinar are doing it from the comfort of your own homes. And that's just symptomatic of the changes which we've all been through. Before I ask John to start us off today, let me just say a little about IMAP and COVID and some of the ways in which we're responding to this. So first and foremost, the awards, and I'll talk a little more about that in just a moment, where we're anticipating the awards ceremony in August. Investec, we have the first of our conferences, the next of our conferences in September with its focus on technology. And the portfolio management conferences, one of our most important events. This year, Sydney and Melbourne, and for the first time, Perth, we'll be holding those in November. Through the rest of the year, we'll be having at least one of these webinars each month. Now, let me just say a little about the awards. So the awards are our way of trying to recognise best practice in managed accounts. There are 5 asset class categories: Australian equities, small caps, multi-asset class, fixed interest and international, as well as the licensee and innovation awards. We already have quite a number of entries, but you've got until the 26th of June to submit your entries. And I would encourage you to do that. It's an opportunity to be recognised by the broader managed account community for the work that you put in to working with your clients on their investment outcomes. The licensees category in particular is our way of trying to highlight the fact that managed accounts represent a synthesis between advice and portfolio management. Now, before I hand over to John, let me just remind you that this is an opportunity for you all to ask questions. If you want to do that, simply click generally at the bottom of the screen, sometimes at the top, on the Q&A button, type in the question. It'll be visible to all of us. So now I'm going to hand over to John. John is at Antares and is the portfolio manager for the X20 model portfolio, both a fund and an SMA. And that's symptomatic of the direction of investment management. He's the deputy portfolio manager also for the Elite Opportunities Fund. He's going to be talking about mid-caps and the place, the opportunities which they give rise to, and the place in a portfolio. When John's finished his session, I'll then introduce Hamieh and Angus Mason from Cashel family office to talk about the way in which Cashel is approaching the management of portfolios. So, John, over to you.
Thanks, Toby. I'll just get this to work. Just bear with me for a moment. And there we go. Okay. Just I've got the 2 things going, so apologies for that. So we're going to have a look at the possibility of making allocations, I think, to Australian mid-caps. Is that a good idea at the moment? And if so, what are their benefits relative to other things in terms of Australian shares or other investments? But there's our disclaimer, which obviously is very important. Here at Antares, we think that COVID-19 can lead to very substantial structural changes to economies, to businesses and to business models. We think that understanding those structural changes and their varying reasons can provide significant, exciting investment opportunities. And we believe that mid-cap stocks can be key beneficiaries to this or of this due to the fact that they offer higher growth. They often have disruptive business models. And when you have higher growth and what we have at the moment are lower discount rates, you can get a real valuation uplift for a prolonged period of time. The other benefit, in an area, when we deal with the reaction to the COVID-19 from government and central banks, is that mid-cap stocks provide significant diversification, which we think is important. So when we look at what's happened globally, and we know that the US is talking about another $1 trillion kind of stimulus / subsidy to the economy. It's difficult to know which one to call it. But you can see here, as in May 2020, the reaction of most countries and how they had tipped their, how much they'd adjusted their fiscal expectations in terms of the budget. So Australia was looking at going from a surplus to a deficit around 10.9% of GDP, and that was the highest of all the countries at that time, and Singapore and others. And Australia obviously has a benefit in this area because we already have a very strong balance sheet fiscally for the country, AAA credit rating, and we were about to run a surplus. So we could clearly spend a lot more than a lot of other countries who face a problem. This is quite important, and the level of spending here is also quite important because what we're dealing is very large levels of government debt being issued to support economies through the shutdowns and obviously through what will be an extended, volatile and slow reopening period. Economic activity isn't going to return to where it was for some quite considerable time. Now, this is in the context of a very long trend in bond rates. It's been a 30-year bull market for bonds, if you like, and we can see that in this chart here, whereby we see, the Eurozone 10-year bond rate and the US 10-year bond rate have been in decline, from the start of the millennium and since, and actually before. So, everyone always hoping for a rally in rally in yields. They're always disappointed because it's always a head fake. It's just a very prolonged thing. And this is quite important in the current context because a lot of the borrowing that's going on can be undertaken at quite low rates. And furthermore, the major central banks globally have, what we know now as QE, quantitative easing, where they're buying these bonds in the secondary market, which help keep yields down. And obviously both the ECB and the Fed Reserve and even our own RBA now has ventured into this, and that helps to suppress interest rates. And this has quite a significant technical aspect in equity markets. So you often hear people talking about equity markets, that they look expensive, that this, that and the other because they're expensive, but the discounting mechanism of the value of a share is related to the risk-free rate of the country in which the share is issued. That is the basic discounting mechanism. And you can apply then, various premia for additional risks of equity. But at the end of the day, the 10-year bond rate is generally the rate that's used to value the cash flow of an equity, and that can be translated through a discounted cash flow or discounted dividend model, or it also can be evidenced through elevated or through a change in the price-earnings ratios of markets. A higher price-earnings ratio typically is indicative of a lower discount rate. And so when you have central banks prepared to buy, well, you can see from what the Fed Reserve said on Monday night, that they would buy individual corporate bonds, which is quite a step away from government bonds. And that's fueling a lot of liquidity, and that's keeping a real lid on both interest rates and also volatility. So it's one thing to talk about lower interest rates. If you have high volatility, then clearly the discount rate argument isn't so strong. But when that buying is also suppressing the volatility and calming markets, then the volatility falls, so you get the benefit. And that really helps long duration businesses. And we can kind of see that globally, that, over the past decade, since the crisis of 2008, 2007, 8 and into 9, if we look globally, we can see that the price earnings ratio of what we call value stocks has barely changed. It's just below 15 times. Whereas the price earnings ratio of what we call growth stocks, tech, healthcare, things like that, has really expanded. And that is a function of discount rates more than anything else. And the reason is here, slightly technical, so please bear with me. If we have two companies that we value today. One is a fast-growing company, and that's company A, and one is a slow-growing company, company B. If we use a discount rate to value these shares of 10%, they're identical today. But as we lower that discount rate, the faster-growing company's valuation increases materially relative to the slower-growing company's valuation. And the reason for that is because the future earnings are being less punished. When the earnings are further in the future, the bigger the discount rate you apply, the less you're prepared to pay for them today. When that discount rate begins to fall, you're prepared to pay more for them because you've got lesser alternatives around you. That's part of it, but also because there's not better, well, that's the real reason, there's just not better alternatives. And so therefore, faster growing companies, higher growth companies have more of their value in the future, and that future value isn't being punished by higher rates. In fact, it's being aided by falling rates. Here in Australia, when we divide our market up into the three segments of the large caps being the ASX 20, the ASX mid cap 50 and the small ordinaries, we see that over a long period of time that mid caps have outperformed in terms of share price, but they've also outperformed because they've had faster EPS growth. That might sound funny to some of you. You might think that small caps are the place for growth, but in actual fact, there's a lot of small cap companies. These are the indices, and obviously there are individual companies within those that are different to the average of the index. But small caps run into the problem of having to fund their growth through equity because they're relatively new companies, and therefore they don't have mature enough balance sheets to fund high levels of growth organically. They need working capital, or they might need to make adjacent acquisitions or complementary acquisitions. They need capital. And large companies are obviously mature and don't have the opportunity, the runway for growth. Mid caps fit into the sweet spot, whereby they still have a very long runway for growth on average, but on the other hand, they're mature enough that they can fund that growth organically and don't need to dilute that growth through share issuance. So you get that compounding EPS that you don't get in the other parts of the market, and therefore you get the higher TSR over time. This is aided by the expansion of valuation provided by the fact that discount rates are lower. So we think this is a really interesting argument at the moment, and we see some of it playing out, but it's actually got a lot more to go because it's the duration of this event that will continue to aid this. The other thing to note about mid caps, if I just have a glass of water, is that the space is far more diversified. So if we compare the benchmark of ASX 200, excluding the top 20, which is on the right-hand side of this screen, you can see a very even wagon wheel of all the different segments of the economy. When we look at the ASX 200, we can see a big blue chunk on the left-hand side, and that's financials. So you've got a lot of exposure to financials. That's predominantly Australia's major banks, but also insurers like Suncorp and IAG. The reason this is important is that low rates are really hard for banks to deal with, and insurance companies, they need shape in the yield curve. They need a lower rate today than the rate in the future, because they typically, they take depositors' cash and they give you next to nothing at the moment, and then they lend that out at 2 or 3%. That's the case at the moment. The more shape there is in that yield curve, the easier it is for them. Likewise, for insurance companies, they need yield on cash and fixed interest, because obviously they hold the premiums until they have to pay them out, and they need to hold them in liquid assets, the most liquid and less volatile assets being cash and fixed interest securities, and so therefore it doesn't help them either. So you've got a drag, a structural drag in their earnings, whereas the X20 component, if you like, when you take that out, you can see it's far more diversified. And the other interesting thing is that it's far more full of disruptive companies. The top 20 companies are not particularly innovative. They're not particularly disruptive. They're products of Australia's industry structure, which has historically been oligopolistic at best and typically duopolistic. And so therefore they've never really needed to grow. But what we see today is a lot of disruption, and that's kind of interesting for these mid-cap guys. So that's the background of mid caps and the benefit they're getting. So the government reaction is, to prop up economies. Central banks are flooding the world with liquidity to assist governments to borrow and to provide backstops to financial markets. And this is all helping suppress volatility. It's all helping to lower discount rates, which helps the higher growth profiles of mid-cap stocks. So that's an abstract concept, if you like. So when we kind of try to look at this in a more kind of granular fashion, we'll talk about a couple of different companies. And the way that we've thought about this, we think that at the moment, through this, there are structural beneficiaries whereby business models have been upended or disrupted. And so these companies are long-term beneficiaries of what's taken place. And we think that duration will be rewarded. We think there are tactical beneficiaries, particularly the fact that China was first into this. There was, an exposure to China early on was quite helpful because obviously they began to recover their economy faster. And then leverage business models where companies have had to raise equity because of problems about revenue. You think about casinos which have been closed, or any business that's been closed or shuttered. Obviously no cash flow, but if they're good, solid businesses, you can make money out of helping to refinance them. And not only do you make money on the raising, you typically make money on the re-rating of the company in the market, because the company is no longer considered to need capital. So the overall perception of the business in the marketplace increases. And then there are others which, like any of these attributes, and we're not particularly interested in those at the moment, but we'll talk about a couple of structural beneficiaries. We're going for time. The first one is IDP Education, IEL, its code. And so obviously it's quite topical at the moment with the trade spat with China. Around a quarter of Australia's foreign students come from China. Just to put it into context, IDP has two segments to their business. They provide the IELTS tests, which are the English language tests to qualify for university and certain roles in society. They actually administer them globally, apart from the UK. And they also have a large placements business where they take students from foreign countries and place them in historically Australian universities, but increasingly Canadian and British universities as well. So they are the largest player globally. They are also the only listed player globally, and they are a partner with Universities Australia, which owns just under half the business. This is really important because historically this placements business has been a cottage industry. Lots of small people giving it, lots of smaller companies or local people giving advice, which was trusted or what have you. But a lot of these, obviously, with borders being shut, not just here but everywhere, this flow of students came to a grinding halt. But this idea of migration through education is not going away. It's a way of bringing, ambitious and trained people to the country at an age where they are ready to make a contribution. And countries like Australia and Canada in particular have embraced it. And they're a very significant source of revenue to our universities, Canadian universities, and increasingly to British universities. So it's a structural growth story with a cottage industry background, and these guys are the only listed player, and that enabled them to raise capital, which has enabled them to withstand the liquidity event of the fact that all borders were closed. A lot of their competitors will be going out of business. You may think that COVID has impacted study intentions. It hasn't. It's actually, this is a little old now, but actually this chart updated more recently is even more strong, that people would like to go. People still want the chance to study in a developed world country, because you're talking about people from places like India or Bangladesh, Vietnam, Pakistan, countries where they just don't have this opportunity to study at institutions like ours. And IDP typically supply into the higher end universities. You can see that, increasingly that it's large organisations that provide the placements. And so this trend is already in place, if you like, that the larger placement organisations are starting to take share away from the smaller, but only IDP was listed, so only IDP had access to capital, and we think its market share is going to be enhanced. And you can see right now that it only has 13.2% of its share in Australia, let alone Canada or the UK, where the opportunity is even greater. So by being a listed company, by being the best in breed, IDP has a very significant opportunity to consolidate that market, to take a lot of market share. It's very lucrative. They typically get a commission of around 20% of the first year's tuition fees and things like that. It's quite a material thing. So that's one that we were very interested in, because this business, as I say, has a structural tailwind with a short-term headwind that he couldn't negotiate properly. Another business that we've been invested in for quite some time, which is a structural beneficiary of what's taking place, has been Afterpay. We all know about the shopping from home. We all know that obviously you couldn't go to the shops because they were closed. A lot of organisations chose to shut their stores. It hasn't been a nice experience to go into shops. We know that the physical aspect of shopping has been diminished by what's taken place. And the obvious beneficiary has been online, and Afterpay is front and centre in the middle of that. The other thing about Afterpay is that it's electronic lay-by, which merchants historically don't like lay-by because it's expensive and it's a drag on working capital. Whereas customers have always liked it because it allows them to budget. People increasingly don't like credit cards, and that's particularly so at times like this. And lay-by can be hard to find with a lot of merchants. So therefore, it actually helps the customer provide them what they need, and the merchant provide them with a variable cost form of lay-by. And Afterpay solve both those problems. Because it's the first mover in the space, it has a lot more customers, and because it has more customers, therefore more merchants want to use it. Therefore, there are more transactions, which give them more data. And this has only been enhanced by what's going on. And if anything, this trend to online has seen a whole new clientele of people shopping online for the first time, including older people, wealthier people. We understand that people think that it's just a millennial thing for Afterpay. It's not. The average age of the user is 34, but that's just interesting. This is going to change further still because people are using it for the first time who historically haven't shopped online, and they're going to find the experience quite enjoyable. The other thing about it is that if you're wary of a merchant that you've never heard of before, you don't want to give them your credit card details, you can use Afterpay because they have your details, not the merchant. And so this structural growth of the online shopping aspect, of which they are front and centre, has been enhanced, and we see that continuing. You can see it here in all their major markets, the spike in website traffic. So they're really large in beauty and cosmetics as well as fashion and apparel. So here, if we look at Australia, you can see the spike there in visitations. And that's really important to the merchants because people who come through Afterpay via this channel, they're going to buy. That's why they're there. It's a payment system. And you can see also the spike in the US, which is their biggest market now. So this is a structural thing, and it's accelerated the trend to online shopping. And as I say, it's consolidated their position as the market leader. These are old estimates. We think they'll probably have more than double the number of customers, and they'll probably continue. And people use it more frequently, which drives transactions and therefore revenue and earnings growth. So this is a very long-dated asset growth story, a bit like IDP, a very long-dated growth story. The valuation, therefore, is enhanced by the lower discount rates that are being applied to such things at the moment. And the structural shifts of what's taken place because of COVID enhance their proposition to their customers. And they're two things that we think you can really take advantage of in the market at the moment, where the business model gets a benefit from what's going on. There are numbers for those who are interested, and you can see they've all done well. But yeah, anyway, I'll stop there if I can just work out how to, stop sharing and hand back to Toby. Can't hear you, Toby. You have to demute yourself.
Yes, thank you very much, John. As I mentioned, if you want to ask a question, type it in at the bottom of the panel. There are a couple of questions that have already come in. John, you talked about a long duration equity asset. I wonder if you'd mind expanding on just what you mean when you talk about long duration equities.
Yeah, where you have a long period of predictable growth.
Okay.
Obviously, the magnitude of that growth is difficult to predict sometimes, but ultimately, you've got visible growth for a long period of time.
And another question has come in about your view on interest rates and the level of debt that they support or don't support companies holding. Obviously, if you hold the view that we're in a lower for longer environment, do you have a view on what this means for the amount of debt that companies can hold? I noticed one of your segments was geared companies.
Yeah, it was geared companies, and it was about balance sheet repair. So what's interesting, I think, about that topic is that, yeah, sure, with lower rates, companies can sustain higher debt. You know, if you think about interest cover or that type of thing, but actually they can't. And I think that, you know, twice in the past 10 years, we've seen events whereby debt has been a problem for listed companies. Too much debt. There are models out there which involve significant use of leverage, particularly real estate investment trusts and infrastructure, where the revenue has not been as dependable as people thought it was going to be. So, you know, they've borrowed and they've claimed that they've kept gearing in hand or what have you, but really there have been shocks that have upended this. And I think that the appetite for debt in Australia, at any rate, at the corporate level, will be lower than it has been, despite interest rates being lower.
So do you take that into account in assessing, or what weight do you place on that when you're assessing?
Yeah, so I'll give you an example. I mean, a company that a business that obviously many people might think is a high quality franchise that you might like to be involved with refinancing it would be Sydney Airport. But the problem we see with Sydney Airport is that it's a very slow recovery because it makes most of its money from international travel. And that will be the last thing that recovers. And with such a lot of debt, I mean, Auckland Airport refinanced itself very early in the space. But again, it's going to face the problem that it has that longevity of recovery, whereas a lot of the other businesses will recover much faster. If not to the same extent as they were, they won't. But where the problem with these guys with international travel, it's not just the aeronautical revenue that they forego. The international passenger spends a lot more money in the terminal, and that supports the infrastructure.
Yes. In fact, airports provide some interesting insights into forms of investing, don't they? Because I know, for example, Heathrow is a major holding of some of the industry funds. I looked at you can get an online chart of aircraft movements in Europe, for example. On the day I looked, Heathrow had 3 aeroplanes in the air within a couple of 100 miles of it. You question its long-term value.
I mean, in time it will recover. You know, I have no doubt that in time it will. But when you've got a lot of debt and you're not servicing the debt, because the way that they've enhanced their returns over time is through gearing. So how their lenders think about that. Thus far, lenders have probably been more forgiving than you might have thought, with the idea that this is a shorter term event than people might have thought. But as I say, there'll be an impairment to air travel. You know, we own Qantas, which might sound counterintuitive, but Qantas can structure its arrangements such that it can make quite a profitable business out of domestic travel, and its loyalty business. It doesn't necessarily. And obviously it's competitors in receivership, which is, again, to our point about companies who emerge stronger from this. You don't get a stronger situation than your competitor going to receivership. So Qantas can be a valuable business as a domestic limited international business, but less. You know, in many ways, many investors didn't like the international business anyway. But if you get rid of it, unfortunately, you have to think about what you do with the loyalty business. But that's a different issue. But the point is that they can stagger their recovery. They've got control of it. Right?
Now, there's a question here from Dean Evans. What do you think the impact on APT's entry into the US and UK markets is going to have on their future returns?
So this is a really interesting question. And when you go to the US, I think one of the things you don't understand unless you sort of see it in action. I went to a tech conference. This is a tech conference in San Francisco in February. A really big tech conference full of investors. And there was a venture capital panel up there talking about what they were looking at, what they were interested in. And one of the guys hosting the panel asked the question of the crowd, when was the last time you guys balanced a checkbook? Was it in the last 30 days? And fully half the crowd, half the attendees put their hand up. A checkbook. These are people who invest in tech stocks, right, in the United States, and they're balancing checkbooks. You can't use like the payment environment in the United States is so backward. We're bad enough here, right? But it's even worse over there. And so, and they're used to paying fees. The fees that you get charged are enormous. Right? So, yeah, I can only see it being positive. There's so many opportunities for them over there, and the business model will evolve too. You know, there'll be ancillary forms of revenue, cross-border, so on and so forth. We know the interest from Tencent. Predominantly, we think that's about their WePay business, their WePay users in Asia, maybe not China, but Asia, being able to access US merchants through a platform such as Afterpay, because they can't do it today. So, and that will then include foreign currency revenues and things like that. So we think they'll go up. You're still on mute.
Sorry, that's because one of the things we all learn about working from home is that you have the dog asleep in the back of the office, and just at an inopportune moment, she decides she wants to head out. Look, John, thank you very much for your presentation. I found it very interesting, and it makes a great case for mid-caps in an Australian equity portfolio.
Thanks, Tom.
It's now my pleasure to introduce Hamieh, who's the head of distribution for Xplore Wealth and responsible for client growth and retention in Xplore, and Angus Mason, who's the founder and CEO of the Cashel family office, to talk about managed accounts in this environment. So in a volatile market, in a market filled with uncertainty, the sort of uncertainty John has just been talking about, the use of managed accounts is absolutely central. One of the things which we're very interested in IMAP is this issue of have managed accounts delivered on the promise, and that's a theme that we'll be coming back to in future webinars as a way of trying to unpick the way in which the potential benefits of managed accounts have played out. But back to today. So Cashel Family Office, founded in 2007, so 13-year history so far, now services over 500 aspiring and high net worth client families. So now it's my pleasure to introduce Hamieh from Xplore and Angus Mason to talk about the way in which managed accounts have been used in the Cashel business.
Thank you, Toby. It's great to be here today and to be joined by Angus, and Toby gave you a bit of background as to Angus's business. And you know, clearly we're here to talk about this volatile environment and how we're navigating the environment, and specifically to hear from Angus on how he's enabling advice in this environment with the help of managed accounts, but also some really interesting ways that Angus is using technology in his practice to actually be able to spend more time with clients and create even greater efficiency. So I'd love to kick off, Angus, with just getting you to briefly tell us a bit more about your business from its origins to where you are today.
Sure. So you can hear me fine, hopefully. So look, our business is fairly simple in many regards. It's a business that I established for myself and my family, and it sort of quickly grew from that to being one that your sort of friends and other families really wanted to be a part of. And today we sort of have 500 odd families that are part of our broader family office. And typically the families that would have sort of around $5 million invested with us and somewhere between $2 and $3 million that we manage from a debt perspective. We're a little bit unique in that I suppose we take some of our inspiration around the model that we deliver from more of a European private bank sense than one of the Australian models, because we really try and look after every aspect of our client's financial ecosystem. The same way that, I suppose that I wanted for myself and I wanted for other families is so that you could see and understand your wealth position at any point of time across all the different trusts and structures and all the various other aspects that we have in our lives. So for our clients, they're not typically the ones, they're obviously smaller than what you would expect out of a single family office, but they're typically clients that would otherwise sit with an Australian private bank or something like that. And they're really looking, they're either, business owners, 80% are probably self-employed business owners, or the rest are very busy executives. So when we deal with them, we're dealing on all sorts of issues. Wealth is one issue, obviously, but for most of them, it's around time, convenience, and lifestyle. And so one of the things we obviously use managed accounts for is helping gather and support information around that. But other aspects that we have built in our own CRMs is around how we give and empower clients, and also the other partner advisors, so tax agents and lawyers, to all work off the one page, all work off the one fact find, rather than having all sorts of documents flying all over the place. And the real benefit of that is we don't have points where things can fall through the cracks. And that was really an issue that I always found prior to establishing Cashel, is dealing with multiple advisors and multiple consultants. There's often a great deal of specialisation in each one of them, but they often aren't working off the same page. They're often working in very isolated information. So having platforms and systems so everyone can see everything at the same time and work collectively for the collective outcome, which often is just the improvement of our lifestyles. So that's really been the key to Cashel Family Office, and that's really paying rewards for us now, especially the compliments we're getting from clients, and more so the referrals that we get from existing family members for more family members. So it's been certainly a long journey of 13 years to get it right, and I think we're still always iterating every day. But yeah, no, it's been a great experience.
Fantastic. And I guess this current period of volatility is making you think about how your business will further evolve. But if we focus on your clients, what's become really important to them during this period, and have they changed the way that they're engaging with you?
Well, it's interesting. I mean, we've been lucky enough that I suppose over the last 18 months or more, we've been holding quite a large amount of cash in the portfolios, probably more so than we would normally. And we were probably receiving a fair bit of criticism for that late last year amongst clients, saying, why isn't my money working harder for me, and so forth. I mean, the unique thing about our model is, we're obviously a commercial family office, so we get paid a funds under advice fee. We get paid brokerage fees when we're acting as a mortgage broker or insurance broker. So really for us, we're not incented to transact. I mean, at one point in time, we did have a transactional business or a stockbroking business in our overall business. And that's a very different incentive model to one where you're aligned to the client's interests. So when clients are investing, they're investing alongside what our staff are doing, what our family are doing. So if we thought that assets were overpriced, or we have uncertainty about the future, and whether it would be the Trump geopolitical issues last year and even more so now, then we would do that, because ultimately we're about protecting capital and then growing it when there's confidence in the market. So I suppose, were we expecting the pandemic to be this black swan event? No, but I think we were expecting, some rocky times ahead. In some cases, it so happened that I suppose we've been able to deploy and start to redeploying some of that capital back into the market selectively, particularly around the dip. And what I've found over the last 13 years is, while we've seen a few little dips, I mean, we've had 30 years of positive growth, we really do better in those dips because we often have cash ready on the side with clients to take advantage of those opportunities. So from a perspective of what the clients have really wanted, I mean, the clients are now educated around that asset allocation, risk on, risk off process, and that's part of that exercise of onboarding clients. It can take a long time to educate them around risk control and liquidity control, rather than feeling the need to always be invested, or that fear of missing out. You don't need to be always invested. You need to be selective about what you're doing and methodical about it. So, you know, I think the Corona thing has worked well for us. Certainly, and the clients to a certain degree, and probably in almost all cases, have felt very comfortable with it because they've been able to see where their portfolio positions are. They've had day-to-day communication with us, if more so than probably normal, you know, getting on the phone and communicating with them. And that's the most critical thing for the clients, is understanding where they may sit. Is this really a short-term blip? Which, yeah, we think it is. Will it impact their lifestyles in the long run? No. So it has been certainly an interesting experience, but I think the opportunities are yet to come over the next 12 to 18 months as things run out of puff and there's opportunities for recapitalisation or taking more of an active control in some of our businesses. So time will tell. No one's got a crystal ball, but we'll see.
So can you delve into how you're actually delivering your value proposition, your service proposition to clients, like your process and right through, you know, you do use managed accounts to, you know, the adoption of managed accounts in your practice? Yeah, so I mean, suppose we I mean, within the way that we deliver services, or we have client account teams. These teams are comprised of a financial planner, a private banker / mortgage broker, insurance broker, and admin. So they really look after the day-to-day interactions with the client, the gathering information on the client, whether that be using APIs to do that, or face-to-face sitting down with the client. So we're gathering it from them, the tax agents, and also the lawyers. So the main critical thing to us, and 80% of our role in many cases, is gathering information. Those client services teams then work with a centralised portfolio management team. So we get the scale advantages of having a centralised team around that, obviously, and we're using, in the most cases, separately managed accounts for direct equities and also some other specialised accounts for other clients. So overall, we have an individually managed account platform that we're utilising with Xplore. And then while we're doing that, we're obviously providing planning services, we're helping insurance and protection services, we're helping with borrowing, as the case may be, and investing in administration. I mean, clients do not want to be, and I'm the culprit of it all. We don't want to be doing paperwork. We don't want to be shuffling things around. We really do want a seamless experience. And we know, you know, having operated a stockbroking business where we used IPS, for example, that was a very difficult and manual process when we're using that IRS product. The manual accounts product has really made up for that. In terms of the client services team, so they from a value proposition, they're talking to the client maybe once a week or once a month, depending on what needs to be happening. I mean, we're very keen to be proactive about making sure that we're pre-prepared throughout the year, whether that be, certainly the investment side is one, but overall the tax structuring, the ownership structuring, the pre-planning, the estate planning, and working with specialisations, because ultimately a client's lifestyle is determined by their after-tax wealth, and that yes, investments drive a lot of that, but it's also the structuring and so forth that goes along with it, which can, in many cases, make a much bigger net difference to their lifestyle. So, you know, that's our value proposition, is we do take a very holistic approach, and we're very keen to do that because we've seen and all experienced what happens when that's not taken, and one recommendation conflicts with another recommendation. So, we very much do that. And look, we've tried to do that in many ways, but now certainly we've had to build up our own proprietary systems to support that, and gathering data and things like that, because there is so many data points on every individual that we need to sort of monitor, whether it be their spending habits. For some people, on Afterpay is a great example, or the way through to your pre-plan for the tax in the next couple of weeks if we haven't already done it 6 weeks ago. So, yeah, it's you know, the proposition is a very broad one. There isn't any hidden fees and charges, and there's no hourly based fees. So we try and make it very simple, and we invest clients in getting to know them, knowing that we're going to have a very, very long-term relationship with these people, including their children or their grandchildren, as the case may be. So I think, you know, we heard John talk about some of the themes around mid-caps. are there any of those that resonate with you? How are you managing investment portfolios and implementing your decisions?
Yeah, so I suppose we start very much with a risk-based approach. So are we confident about what's happening in the market? Should we be invested or should we not be invested? And I suppose towards the middle of last year, we were taking more of a conservative approach, saying we think there's going to be opportunities, or we just think the market's becoming a little bit unpredictable. And yes, I think, you know, a lot of that obviously has been inflated by, you know, monetary easing and so forth like that. But ultimately, if we don't have confidence that the real lifestyles are improving, so wages are going up and things that are really tangible to clients, then there's got to be a case where we were feeling that there's unpredictability. So we certainly start with a very active approach of should we be invested or shouldn't we be invested, and we're quite happy to sit on cash on the sidelines. And then it comes down to, once we've started at that point, we're looking at asset allocation. So we have the advantage that when we look at a family, we see all their assets, whether it be a car collection, art collection, a holiday house, or whether they're just young executives getting going pre-children. So we have one thing we don't want to do is duplicate their asset allocation. And what we find is obviously when clients come to us, like all clients, they already generally have a fairly large, proportionally, direct real estate exposure. So real estate, whether it be leaks or whatever the case may be, are not something that we typically put in a client's portfolio. And certainly, you know, one of the other reasons for that is we like to see what we're investing in. So we like to be able to call a CEO and have a conversation. We like to be able to call the portfolio manager and have a direct conversation. So typically the way we operate, 30% of the asset allocation we manage through direct equities internally, and that's run by the portfolio management team, who have a very active dialogue with the investee businesses they're managing, as you would expect. And then 70% of the asset allocation is typically allocated out to other mandates, whether that might be various managers in small cap, mid cap, large cap, international, alternatives, commodities, and some other aspects. We also do have allocation to private equity, and typically that's more so where clients have an active role in that private equity, so they can bring something to bear. Because we act as a family and collectively all our members are adding to that flavour, we really do focus on opportunities where we can add advantage. So if we're going into a private equity opportunity, is there board members that we can pull from our client base? Do they have knowledge of the industry? Are they able to generate sales? Is there something they can get interested in? And really, I suppose that family office flavour is really what we bring to it, is because we've got a lot of busy clients. And for those who are retired, they still want to be very active. You know, they've got another 20 or 30 years. So they all play a role in that asset allocation framework. And then I suppose once we have that asset allocation framework, then we do really filter down to that investment selection process. And as mentioned, it comes down to clarity and confidence of information. And in all those cases, we're either running them as individually managed accounts or separately managed accounts, or for the smaller clients, it might be model portfolios, depending on where they have. And obviously, one of the things we've been working on is how do we improve the administration for that. We've got a lot of clients who have become tedious of using their self-managed super funds, is a great example. And so one of the products that you know that we've been working on with you is building a retail product out, so we can either, even for the larger clients who have a self-managed super fund, they don't have direct equities in it, they're not using it for making their children as members in it. There is a great opportunity to reduce costs and simplify administration, so there's more clarity around where their portfolio sits at any point in time in a retail superannuation product. So there are certainly platform aspects that we're working with, as well as having a fairly rigorous asset allocation investment framework that we're doing through. And I suppose that's always evolving, as frustrating as that can be. It is evolving and iterating, but we make mistakes and we learn every day. So hopefully every day we keep on improving that experience and outcome for clients.
Yeah, it's great. It's definitely evolving with our collaboration, Angus. And I think, clearly from the way that you're running your business and what you want to achieve for your clients, you need the IMA or managed accounts proposition to enable that with its flexibility. But if we look towards, improving client services even further in this environment of regulatory change, in this environment of market, volatility? What else are you working on to deliver more for your clients?
So I suppose it's an interesting proposition. I mean, all those regulations, whether it be the new FASIA implications or various regulations that have come out more recently, I suppose in many regards we've been ahead of that, and it hasn't been necessarily because of foresight, but probably mistakes that are made. When we had, for example, when we had the stockbroking business, it was there's very different motivations. That's a very transactional business versus a family office business, which is pretty much funds under advice. So one of the common things you want to be able to do, obviously, through this process is align everyone's interests, and FASIA is trying to do that around remuneration and agency arrangements, which should be really obvious. If the advisor should only win when the client wins. So if wealth goes up, everyone's a winner. If wealth goes down, everyone needs to feel the disadvantage of doing that. So I suppose what we've been working on and knowing that is, how do we gather all the information on the clients? And we've tried various applications over the years to try and gather it all into one database. And ultimately, we've moved on to building our own database mixture between a platform in Atlanta and also using Microsoft Dynamics to expand that out, so that we can gather all the information all in one spot, and we can really enforce the compliance regimes that we want around client service delivery. The disadvantages of some of the platforms out there now is there's no hard stops. So we treat, regardless of the client being whatever size they are, we treat them as a retail client. So that means statements of advice, records of advice, proper discovery, proper information. And there really needs to be hard stops about ensuring that is done before the next stage of investment advice is given. So we manage that all through our CRM, and we manage that, which is our custom built one. And we manage that ongoing review process on a weekly and monthly basis through that. We can see the interactions and behaviour and engagement of the clients through that process as well. So I think certainly the way that the regulations are going are as what you should expect. I mean, they're certainly for the benefit of the client. It's just a question of whether the software and the processes that are readily out in the market are keeping up. And I think you and I have discussed this as how we improve our processes. So there is hard stops on certain things, whether it be around the annual fee disclosure statements and things like that, to ensure that there can't be any, charging of fees when someone hasn't re-engaged you to keep going. I mean, it's exactly what you'd expect to go to a PwC or a big accounting firm. You'd expect this engagement letter happens every year. So why doesn't it happen in the advice industry? So simple things like that, which are common sense, which we're really enforcing through our business processes and mandating through our own proprietary CRM system. So yeah, I think it's certainly all going in the right direction, but I think it can be a full-time job just focusing on IT by all means. So look, so I think you and I have these discussions all the time about that. So it can be very daunting, but it is kind of iterating those issues from time to time and seeing what can be done.
Yeah, and I guess, there might be a number of advisors tuned in today thinking, I do want to automate the advice process further, or it may seem, daunting to tackle too much in one go. What are some of the tips that you might be able to give the audience around, maybe some of the challenges you've faced and, some tips on how you've overcome things, what you've done quickly?
Yeah, so look, one of the advantages I suppose I've got in this business is I was trained as a computer system engineer, 20 odd years ago. So one of the issues of when engaging in that IT development is being able to speak the same language. And often IT consultants and financial advisors IT consultants and any person don't speak the same language. So being able to speak a similar language is the starting point. But you really do need to start with looking at your own business and saying, what are all the processes, what are all the communication steps, and what's the workflow that engages with every one of your business lines and the clients, and getting your staff to engage in that process. So where does it work, where doesn't it work? So when you think about automation, you've got a proper understanding of where the really manual points are. And there is some great applications out there to start off with. I mean, Advisor Logic, as example, has a plugin with Zapier, which can automate a lot of simple processes. I mean, we've obviously gone down a process of using Microsoft Dynamics as an example, but which can become expensive because, but it has a lot of the artificial intelligence and machine learning capacities that you can do to remove a lot of day-to-day things, and that might well be, pulling data out of a client's credit file so you know where the debt obligations are at any point in time, or just processing and generating forms rather than having, so that might be pre-filling forms through a plugin. And you can certainly do that with a Zapier, where you might have an application form that you simply want to click and fill in. So you can start with some really basic things. You don't need to go over the top in many regards, because it may be as simple as you just wanting to have one database where you can communicate with the client through something like MailChimp or AdvisorLogic or whatever the case may be, rather than having to build your own, I suppose, portal and go through all the ATO testing and all that sort of stuff, which is done yourself. So you start small on little things and then see if the business grows in size, then iterate. But don't try and do everything all in one go, and certainly don't. That'll be the end of anyone, I think, in most cases. So, yeah.
That makes sense. Just conscious of time, and just one final question around during this period, what is one of the key things that you've learnt that will impact how you do things in your business moving forward?
Well, look, it's a very interesting question. I would say in many cases it hasn't changed much. We really have been, while I like coming to the office, the other staff have been very happy working from home and very productive working from home. The thing that we've and because we can work remotely, there really hasn't been a big issue. If anything, it's making sure that all the staff's home offices have been set up to work remotely so that they can go there. I mean, there has been, obviously Zoom's been fantastic, and being able to do digital verification of people and things like DocuSign and stuff like that have been great to keep the business going where there's those bottlenecks. Ultimately, there's still some things that have really been highlighted, and that's just being able to sit and have a coffee with a client and see their reaction to challenges. Because often we're not talking about just money into an account or not, we're talking about challenges that impact their lifestyle, where we're looking for reactions on their faces when we ask an awkward question. And for, I suppose, a number of weeks there, I suppose our staff were making up for their coffees by walking around the park 5 or 6 times with different clients every day. So maybe that's not a bad thing. And if we can continue doing that, that's probably a great thing for the health and well-being of our staff and our clients. But just getting back to being able to sit and have a coffee with a client and really talk, keeping up that face-to-face communication has been really something that we've probably missed a little bit, that we really are enjoying looking back to get back into, hopefully shortly.
Never take that face-to-face meeting for granted again, I think.
Yeah, well, so sometimes you are the counsellor, and sometimes you've got to say to some things as they are. So we're not, I mean, that's the advantage we are. We can pretend to be family members and have honest conversations as you would a family member. So not always pleasant, but the benefit is there once you have them.
Right. Thank you, Angus. Toby, I think we're right on time, so over to you.
Yeah, look, thank you very much, Anne, and thank you, Angus. I found that fascinating, and in fact, it made me realise that as we put Investec together, one of the things we always try to do is to draw into the presenters those people running advice businesses have had to think through their whole technology stack. So expect a call from us about your approach to technology. There's a question, as I mentioned before, if you have a question for Angus or Anne or for John, use the Q&A button at the bottom of your screens. There's a question here, and you touched on it very briefly, about wholesale or retail clients. I mean, I imagine many of your clients would qualify as wholesale, but I think you mentioned you treat them as retail. Why is that?
Yeah, so I suppose, look, almost 90% or 95% of our clients would fall into the bucket if they elected to be wholesale or professional clients. And then maybe their children might be classically retail. Look, we treat them all as retail clients unless they specifically ask us otherwise, because we think that everyone deserves the benefit of getting proper advice. And I think My experience in the past, particularly seeing having a brokerage business, is there tends to be a want for advisors, in some cases more direct equity advisors, want to use 708 documents as a way of avoiding either giving SOA or to get them to participate in small cap or micro cap capital raising. So I think there's a much better way to do those kind of things, and that's why we always prefer to treat all clients as retail clients, because for us, our systems and processes are set up so it makes no difference for us. We can generate statements of advice very simply and very easily. We can be very succinct in the way that we're delivering that, and so there's nothing to sort of get in the way of doing that. So I think that just leads to actually better advice, actually having that discipline to do that.
Thanks very much. And now one final question here, which is that the type of client base that you have, often those people have strong investment views of their own. They believe they have knowledge of this sector or that sector.
Yeah.
They've got a view on where interest rates are going or what we should do about China. How do you incorporate client views into your own investment philosophy?
Yeah, so I suppose we don't, outside the smaller clients where we run to risk-based models, all the larger clients are all operating under individually managed accounts. And for that very reason, because you will have certain clients that have been ex-board members of banks or have been, I suppose, trade consulates or things that where they have very strong views about certain things. And to a certain degree, where we focus is the risk on, risk off around those individually managed accounts and also their asset allocation. So we can obviously change and we work with the clients often in that investment selection process to ensure that the investments that sit within the asset allocations are ones that the clients are comfortable with. There's a simple test is if you can't sleep at night on it, just don't do it. And from our perspective, there is no incentive for us to be, in many cases, for the client to be invested or uninvested. So look, and quite often those are the conversations that we really enjoy, because often we learn things from the client about their experience in a certain sector or information about what they're seeing on the ground, or and we'll use that information in some of our recalibrating our typical portfolios, because they'll certainly have information where they're operating, which sometimes when you spend too much time in an office, you're not spend enough time walking around factories and seeing the behaviour of people on the ground. That's what you really want to do when you're investment managers sometimes, and that's the more enjoyable part often. So
there's no alpha in the office is an expression I like to use.
Look, John, that's absolutely right, and I can tell you that one of my near neighbours is a very recent senior executive of Afterpay, and has just bought a bigger house. So Anne, Angus, John, thank you very much for today. The recording of today's webinar will be up on our site within a day or so, and John's presentation will be available to you all. We'll be sent, those of you who attended, thank you very much. We'll be sending you the CPD certificates within a day or so. So we look forward to you participating again in our webinars. As I say, a key theme for us, and one which we'll be addressing in future webinars, is really have managed accounts stepped up at this time of market turmoil. So thank you all, and we look forward to you joining us again. And if you're an awards candidate, don't forget, get it in by the 26th of June. Thanks very much.
Thanks, Steve. Thank you.